Hi, I'm Todd Russell, and I'm a certified financial planner professional in Nashville, Tennessee. I created this site and these videos to teach and inform about long-term care insurance product solutions, how they work, the different plans, and to inform you as a consumer what's available in the marketplace so you can make a well-informed decision. So this presentation is a detailed review of traditional long-term care insurance. You can find more videos and information on my website at www.myltciplan.com. So when you're designing a traditional long-term care policy, there are several levers you can pull to adjust the balance between cost and the benefits you create. So these decisions impact both your premiums and how much protection you'll have when it's time to use the policy. So first, there are built-in spousal discounts. If you and your spouse both apply, even if only one of you ends up accepting coverage, you'll usually qualify for some level of premium discount. And that's a simple way to improve affordability right out of the gate. So hybrids and the life with long-term care riders also have discounts for couples built in. And good health is also a driver of the premium cost. Next is inflation protection, which is one of the most important levers you need to get right. Care costs are projected to double every 15 to 20 years, so if you're buying coverage in your 50s or 60s, your benefits need to grow. Compound inflation, especially 3% or 5%, can make a huge difference over time. It's going to be the difference between having $4,000 a month or $8,000 a month when care is needed. The elimination period is your waiting period before benefits kick in. So think of this like a deductible measured in days. Most policies use a 90-day elimination period, but some plans can adjust that. Some count calendar days and others count service days. And so that's a subtle difference, but it can really affect how fast benefits begin. So as an example, there are 90 days from January 1st to March 31st. If you have a calendar day elimination period, you just wait 90 calendar days before benefits begin to pay. But if you have a service day period and you use long-term care services every other day, then on March 31st, you'll only have 45 days that count towards your elimination period. And it's important to know this subtle difference because it's a big deal. Then there are optional features like shared care, which allows spouses to tap into each other's benefit pools if one of them runs out. And you also have a return of premium, and this is a rider that's added to the policy that can refund a portion of your premiums if you cancel or die without needing care. And these add cost, but can also add peace of mind. And these same features are built into the hybrid plans, so be sure you watch that video. And we can model different designs based on your age, your health, and whatever preferences you may have. We can run the numbers, compare designs, and find the sweet spot between protection, budget, and peace of mind. Simply fill out the quote request link in the video description or on our website. So one thing that sets traditional long-term care insurance apart from other types of coverage is that premiums are not guaranteed. So the insurance company can raise your premium in the future, but they don't do it just for you. Increases must be filed with the state insurance department, they have to be approved, and they have to apply it to an entire class of policyholders. And most rate increases we've seen are due to a couple of things. People are generally living longer, and fewer policies are lapsing than the insurers had originally expected and priced into the policies. So that means more claims over a longer period of time, and that's why they're increasing the rates. But not everyone does see a rate increase, and for a lot of clients, it's a small trade-off for access to care that's generally going to be worth hundreds of thousands of dollars. But it's important to go into this with your eyes wide open. My experience has been most people that once they get into retirement and their earned income is gone, they don't necessarily want to have the uncertainty of increased premiums. And if a rate increase does happen, most carriers are going to provide options for you. And those options might include reducing your benefit amount, maybe lowering the inflation growth factor, or decreasing the length of months that your policy might pay a benefit. So let's talk about the underwriting process for traditional long-term care insurance. It's generally going to be medically underwritten. So that means you must apply and the insurance company will evaluate your health to decide if they'll approve coverage and at what price. So if you have any major health concerns, approval might be a challenge. As an example, if you currently have any physical limitations like difficulty walking, using a cane, or needing help with your mobility, that's generally going to be a red flag for most carriers, and they will not approve anyone with those issues. Or you might be currently receiving physical therapy, or maybe you recently completed it. So that's going to get a little extra attention. The carriers want to know whether that condition has resolved, if it's ongoing, or if it's expected to worsen. So they'll dig in a little bit on those issues. And if you have any pending surgeries like knee or hip replacements, spinal surgeries, or anything orthopedic, it's likely that the carrier is going to postpone you until the procedure and the recovery period have ended. In the underwriting process, usually involves a health exam, a phone interview, a review of your medical records, and a prescription history check, and sometimes a cognitive screen, especially for applicants who are over the age of 60. So the live, quit, or die framework is a good way to evaluate any long-term care plan. So you need to be able to answer the three basic questions. What happens as you live? What happens if you choose to quit? And what happens when you die? So let's start with the first scenario, while you're living. And by that I mean you live long enough to need care and go on claim. So with a traditional long-term care policy, you're going to pay annual premiums for protection. And remember that these premiums are not fixed. They can increase in the future. Generally, once you go on claim, your premiums are waived if your policy has a waiver of premium on it, or sometimes that's just how the policy works, is when you go on claim, premiums stop, and you're not going to be required to pay premiums while you're on claim. And meanwhile, your premiums have been funding a benefit pool that's growing if you elected inflation protection. So that means your available benefit is increasing every year, even while you're healthy and generally while you're on claim. So the next is, what if I change my mind scenario? So maybe you don't need the coverage later. Maybe your life and financial circumstances have changed, and this is where traditional long-term care is going to be limited. It usually doesn't return anything unless you've added a return of premium rider, and generally it's not a full return of premium. It might only give you 3 or 6 months of premiums in return if you quit the policy. So it's best to think of a traditional long-term care policy as a use it or lose it type of a plan. A lot of plans do have a non-forfeiture benefit, and this is a feature that gives you a long-term care benefit that's equal to your premiums that you've paid in or some variation of it. And last, this is where traditional long-term care is often criticized. If you never go on claim, there's typically no benefit that will pass to your family or estate. And that's not wrong or a bad feature in the policy. That's the trade-off for a lower initial premium and the risk of premium increases in the future. So let's talk about how you can pay for a traditional long-term care policy, because a lot of people are surprised to learn that there are several ways that you can fund one. The most common approach is to pay it over your life, and generally that is the only option for traditional long-term care policies. In the past, they used to have time periods of 10 years that you could pay it over, but they took those away several years ago. And with life pay, you'll pay your premiums annually or monthly for as long as the policy's in force. It's kind of like a health insurance or a homeowner's insurance premium. You may also fund your long-term care premiums with a health savings account if you have one. Traditional LTC premiums are an eligible expense for an HSA, so you want to make sure you connect with your accountant to make sure this is recorded properly. And premiums for traditional long-term care insurance can also be tax deductible if you itemize your deductions. So at the time of this video in 2025, for individuals, premiums qualify as a medical expense under the IRS rules. They're deductible to the extent that your total medical expenses exceed 7.5% of your adjusted gross income. But there are also age-based limits on how much you can deduct each year. So as an example, for 2025, those limits range from around $480 if you're someone under the age of 40, or those deductions could be up to $6,020 for someone over the age of 70. And those numbers generally change each year based on inflation and other data. And if you're a business owner, you have some additional options. Premiums can be deductible to the business as a legitimate business expense depending on the structure of your business. C Corp, S Corp, partnership. You want to make sure you connect with your accountant to ask and see if that's an option for you. So whether you're paying personally or whether you're using HSA funds or leveraging business deductions, there are beneficial ways to fund traditional coverage. And these options also apply to some of the hybrid plans, which we'll cover in the next video series. You should have a better understanding of traditional long-term care plans now, how they work, and the funding options. So if you're curious about cost, you may visit www.myltciplan.com and go to the pricing tab and see sample cost and benefits. So if you want to see a custom proposal for yourself, fill out the quote request link in the video description or on our website and we'll send you one. So now you've seen an overview of traditional long-term care. To make an informed plan, be sure to watch the rest of the series. Hybrid long-term care, life with long-term care riders, and annuities with long-term care riders, so you can weigh every option side by side.